Today I'm discussing here about different types of insurance, life insurance policies. Not only policies, but life insurance policies. Okay, because there are n number of so many types of insurance policies according to your will, according to your requirement. As a insured person, you go for any type of policy. So first of all, we discuss the policies on the basis of time. On the basis of time, we have first policy, that is whole life policy. What is whole life policy? It means the policy, the amount will be paid at the death of the life assured. Under this policy, assured cannot get policy amount during his or her lifetime. Understand? The assured will not get the amount. Okay, if the person alive, he will not get the amount. Only his or her dependent will get the advantage of this policy. So this policy is not for the benefit of the insured person, but for the benefit of the all other family members. So this whole life policy again divided into different parts. One is ordinary whole life policy. Under this policy, premium is payable basically throughout the lifetime of the person. Person means assured. The policy money shall be payable after the death of the assured, and this policy provide full protection to wife, kids in case of husband's policy. In case of wife's policy, security will shift it to husband and kids, right? The only disadvantage of this particular policy is that assured has to pay premium throughout the life. Okay, throughout the life means, suppose if person alive 90 years, so he has to pay the premium to the party till the age of 90. Then we have single premium whole life policy. Single premium means the policy is not the amount, total amount you not have to pay, annually or monthly. You have to pay the premium once in your life. Okay, once in your life, when you go for the policy, at that time you have to pay the single lump sum amount to the insurance company. Then we have limited payment whole life policy. Limited payment means in this policy, the insured pay the premium, say for fixed time period, for till the age of 58 only, or till the age of 55 only. And the benefit, that is sure, the benefit will not you can say goes to insured person or assured person. That benefit shifted to only the family member after the death of the person. Then we have convertible life policy. This is also a part of this whole life policy. Convertible means, um, if we can say that its holder an option to get it converted at the end of, say, 5 year into an endowment policy. If this option is exercised, the policy no longer remains in the whole life policy, converted into endowment one. Means you have right. Say you pay the maximum sum assured for which a policy will be issued under this scheme, maybe 10,000 rupees, and the maximum age at entry maybe 45 year. This plan is introduced by the company to meet the need of the young people. Okay, so in simple words, you have to write in the examination that this policy is a whole life policy which provides its holder an option to get it converted at the end of 5 year into simple endowment policy. Now we have endowment policies. What are those policies? These policies, in fact, um, endowment policy, money shall be payable to the assured if he alive up to the term of the insurance, right? If the assured alive up to the term of insurance or his nominee in the event of early death of the assured. The endowment policies are many type of endowment policies. Just try to understand what is the meaning of endowment policy. Under the endowment policy, money shall be payable to the assured if he alives up to the term of life insurance or his nominee in the event of early death of the person. So we have different types of endowment policies. First one is ordinary endowment policy. In ordinary means under this policy the amount become payable on the expiry of the term of insurance contract, or in case of the death of assured person, but before the maturity, right? The assured is required to pay premium throughout the term of the insurance or at the event up till the death of the person. This policy provide an ideal combination of both family protection as well as investment. Why this is investment? Because you have to pay the premium to the company, uh, to the, we can say, you pay payable on the expiry of the term of the insurance contract or at the time of death. Then we have pure endowment policy. What is pure endowment policy? The sum assured is payable to the life assured if he survives till the term of the policy. Nothing will be payable if death occur before the term expire. Means living too long is basically the, you know, pure endowment grants protection against living long life. Otherwise, they will not pay you. Under this policy, the sum assured is payable to the life assured if survive till the end of the policy. Before the policy, if the person death occurred, in that case, nothing is recoverable. Double endowment policy. What is double endowment policy? Mm, Under this policy, the amount payable to the insured is double the amount of sum assured. Okay. What is the sum assured? They give you the double amount if the assured survive up to the term of the policy. You have to mention, clearly, because this if this question is very much in the examination, so you have to write about each and every policy. You just mention 2 or 3 lines for every type of policy. Anticipated endowment policy. Under this policy, the sum assured are payable to the insured in installment during the term of the policy at regular intervals, and the balance at the time of maturity of the policy, right? Um, no loan will be granted against such kind of policies. The joint life endowment policy. What is this? This type of policy cover the life not only the single person but two people, say husband and wife both. The assured sum is payable on the expiry of the insurance term or death of either of the party, either husband or wife. Then we have children deferred endowment policy. Guardian or father or mother of a child want to take an insurance policy on the life of the child, under which premium is paid by the parents or by the guardian or by parents, either parents, the first few years, and by the child after that. Means in the initial year, parents pay the premium to the company, and afterward, when the child become like major, in that case he will pay the sum. Then we have fixed term endowment policy. This is also known as marriage endowment policy. Under this policy, the sum assured is payable only at the end of agreed period, that is very much mentioned in your policy bond, but the premium cease if the death of the policyholder occur before the policy mature, and the person who depend upon that means the beneficiaries, they will mature the policy, they discount the policy from the insurance company. Education endowment policy, like marriage endowment policy, this policy is also taken by the parents. The child for whose benefit policy is taken is called the beneficiary, and the lump sum amount is payable in equal installment over a period of 5 years. Okay, means the policy sum assured is not payable lump sum amount. He pay the amount on different regular intervals. Then we have a very important question for 4 marks, that is difference between endowment policy and whole life policy. First point of difference is term of the policy. The term of endowment policy is fixed by both the parties and generally less than the whole life policy, but in case of whole life policy the term is very long, even not known by the insured also. Insured don't know na, what will be the life, what will be the consequences in the near future. Okay, because we people are not god. Okay, that's why we can't predict to how many year you have to pay the premium to the company. Rate of premium in case of endowment policy, premium is high. In case of whole life policy, premium is low. Liability of the premium payment. Liability of the premium payment is basically fixed time period or till the death of the assured, means assured pay the premium. In case of whole life policy, premium is paid till the insured alive. Then we have next point, that is object. The main object is to make financial arrangement in the old age, but in case of whole life policy, the main objective is to make financial arrangement for the family, because whole life policy is basically for the family, not for the assured person, but that endowment policy is for his own sake. Use of assured amount, last point. Under this policy, assured amount can be used by the insured. Under a whole life policy, the insured amount can never be used by the insured, but in case of endowment policy he can use. Then we have terms of insurance policies. Term insurance policy, not terms of term insurance policy. Term insurance means this is a very short period policy. This policy provide life insurance protection for a limited time period of time, say for 3 7 year 10 year. Okay, it starts from 1 month, 2 month, 3 month. The sum assured is payable only in the event of death of the life assured during the insurance period. Nothing is payable in case of assured survival. Understand? In this case, policy starts with, for 1 month, 3 month, but up to 10 year, sometime even 7 years. The amount recovered only if the person alive at the time of death cannot be recovered from the company. This is again of three type. Convertible term policy. Convertible means insured under this policy facilities to insured to convert it into the whole life or endowment policy. You can convert, you as a insured convert your policy from one to another. You have to inform to the insurance company and you convert it. Then we have diminishing term policy. Diminishing term policy means this is an insurance policy mainly for the loan transaction. An important, very important feature of this policy is that policy money goes on diminishing year after year as the payment of premium is continued. If you pay premium continuously, then year after year you have to pay less. For example, a creditor can take a policy on the life of debtor as a safety against the loan. In the case of debtor death, the insurance company is liable to pay the difference to the creditor. Then renewable term policy. The policy is renewable at the expiry of the term for an additional period without the medical examination. The premium rate will increases because of more age. This policy is stable for those whose health, day by day going down, right? Then we have policies on the basis of method of premium payment. Single premium policy, the policies which are basically premium is paid at the beginning of the policy, and that is the highest amount, lump sum amount, that is known as single premium policy. Level premium policy means an equal premium are paid at regular intervals like yearly, half yearly, quarterly, monthly, to the company, and company will pay you premium according, give you, some assured plus bonuses when the policy mature. That's all for today. In the next video, I will discuss the second part of types of insurance policies. Thank you.